Are you an investor or a business owner? I'm actually both. One of the things that is the most painful for me when I want to buy a property is gathering all my financial documents. Did you know that there is a program that you can avoid all that stuff? I'm going to tell you about it today. Hi, welcome to Invest with Jim, where you'll find real estate insights that no one else is sharing. I'm Jim. I'm an investor and real estate agent. Today, we're going to talk about a loan program called a DSCR loan. I have my mortgage advisor, Wes Freedman, with me to help explain the situation.
Good to see you again.
First and foremost, what is a DSCR loan?
It stands for Debt Service Cover Ratio. They're probably the easiest loan you can ever do. The DSCR loan is to provide a loan with limited documentation based upon an investment property. So these are investor only. The biggest component is rental factor. They're looking for the rents to be close or near the actual mortgage payment. So it's almost vetting. Yes, you need to have a proper credit score. You have to have a certain down payment, 20% or more. And then they're going to really look at what is the rental factor of the property? What would it rent for and what is the payment?
And you said that they're not looking at income at all?
They don't at all.
So I don't have to provide all my tax returns?
Not one bit. We would ask for your assets, proof of assets that you have the down payment. It cannot be a gift. It has to be your funds. They will ask about your property. So if you own 10 different properties in your portfolio, we have to list those on the application. We don't need mortgage statements.
What's the credit score?
Most cases, we're going to use 660. If you're bringing in a heavy down payment, you can get under a 660 score, but you're going to want to have that or higher. Let's assume that you're buying a home and the mortgage payment's $1,000 a month after you put your 20% down. And they do what's called a market analysis, and they're going to figure out what would it rent for. In this scenario, if the house would rent for $725 or more, you do not provide income, you show your assets for down payment.
You're approved already, just like that. Are there any reserve requirements on this?
No, we will show bank statements to show that you have the down payment. That's it. So this is really useful for people that are self-employed that have a tremendous amount of write-offs.
Well, one thing I've been noticing a lot in more recent years are people are doing short-term rentals like Airbnbs and stuff like that too. Those nightly rates and projections, they fluctuate a lot. So what do we do in those situations?
I mean, ideally that's helpful to the qualifying parameter, because remember, they're going to look at rents versus mortgage payment. And we know that if you have a short-term rental, it's likely furnished. It does demand a higher nightly rate. So it's just going to help the qualifying parameter.
How do we get those estimates?
A system called AirDNA, which would analyze like properties for short-term rental and give us an amount.
If you're a short-term rental host or you're doing Airbnbs, you probably are very familiar with what AirDNA is. When I do short-term rentals, I look at that to kind of get estimates or projections of what kind of income I get to. So you can use that as the projected rent?
Absolutely. And you could use that in conjunction with the anticipated occupancy percentage. Like out of a 30-day month period, you're occupied half of the month. So this will help definitely allow you to have that rental factor that you're looking for.
Well, if you do short-term rentals, your revenue is going to be higher just because you're renting it out on daily rates or weekly rates versus like a traditional long-term 12-month lease or something like that.
Yeah, and fully furnished will usually demand a little bit more too.
Who normally uses DSCR loans?
Anyone can use it. You don't have to be self-employed.
You were saying probably business owners that write off a lot of expenses.
So if you're a sophisticated business owner with multiple companies, it can get labor intensive, like such as yourself, when you go to refinance or buy a home. A lot of paperwork involved. So sometimes, being that they are business people, time is money, and they don't want to mess around with that. And they simply want the path of least resistance.
Not having to gather up all those documents.
Exactly. And they're not so interest rate sensitive because perhaps they're putting 50% down. It depends, case by case. My job though is to give them all their options and definitely present both situations, whether or not you want to do a DSCR or a regular full income qualifying loan. These are for those that may be writing off too much in income on their business returns, so they can't qualify without using a DSCR, or like we talked about, just for sake of time.
What do you think are the main advantages of this loan?
Simply, I think it's the no traditional income requirements and documentation provided.
What are some other advantages that one could kind of use in this situation?
Commonly, it would be what's called an interest-only option. So some of my investors are okay with buying a home and maybe not positive cash flowing, maybe going in the whole negative monthly, a couple $100 per month, and they're okay with that. Those that aren't and they want to see some positive cash flow, they will opt for the interest-only option, which is going to bring down the monthly payment to allow for rents per month.
When doing a DSCR mortgage, there is an interest-only option. So your payment does not have any principal payments to it. It is just the interest of it. And that's going to lower your monthly payment, which will help you positive cash flow more that way because you're only doing interest-only options on it.
Correct. And the balance isn't going to change unless you pay additional principal.
Before we move on to the next segment of this video, let's take a quick moment here to hear from our sponsor. Thank you to FSA Store for sponsoring this segment of the video. Do you have a FSA through work? A lot of people do, but they don't always think about this until the end of the year. Maybe you had one of those good years where you didn't have to go to the doctor very often, and then you realize you have this balance left in your FSA account. Well, if you don't use it, you may lose it, and that is where FSA Store comes in. FSA Store sent me these products. Most people don't think that these are eligible to be charged to an FSA account, and this is a great example of everyday items that I need to buy already. Because if I'm buying Advil anyways, and I got money in an FSA account, might as well buy my Advils here. A lot of people think a flexible spending account is only for prescriptions or doctor visits, but it can cover much more than that. Everything on FSAstore.com is FSA eligible, so you're not guessing if something is covered or trying to figure it out after the fact. They have over 2,500 eligible products, including everyday items like pain relief, allergy medicine, high SPF sunscreen, first aid essentials, and many other health-related products. And the part that I like is the simplicity. You can use your FSA card right at checkout, which helps avoid the hassle of submitting receipts or wondering if something is going to be approved later. So if you have an FSA and want to take advantage of it to the fullest potential, go to FSAstore.com/investwithjim or scan the QR code on the screen and start shopping today. Thanks again to FSA Store, where everything is eligible, for sponsoring this segment of the video. You can find more information on that down below, but now back to the video. Those are the good things. What are the disadvantages now? There's got to be a catch, right?
There's always a catch. In some cases, going to be slightly higher interest rates than that of a regular Fannie Mae or regular conventional loan. Anywhere from 1/4 to 3/8 of a point higher, maybe in rate, but not in all cases.
Not even a whole point.
Disadvantages, they are a little bit more costly. The closing costs would be higher. Maybe 1 percentage point more than what you would normally encounter if you were to not use a DSCR. And then finally, the prepayment penalties that they come with. The standard would be 3 years.
Why do you think there's prepayment penalties on this?
If you were to lend out your own money, you lend it over a period of time, right?
Right.
Which is how you make your money on interest. If you pay off a loan soon, I gave you the money and I charge you a certain given rate, I don't make that return if you pay me off early. And so they're going to punish you for that because they're not lending out money for fun. It is a business.
These DSCR loans already have a little slightly higher rate though, right? But just think about who's using these loans, right? It's business people. So what Wes is saying with this is, if I borrowed a big chunk of money and I'm just using it to kind of get me through to the next point, right? And let's say I pay it off in like 2 years. The lender didn't really get a chance to make much interest on you, right? Because you kind of use them as like a short-term loan, right? So that's why they're charging the extra fees for the cost of you using their money and giving you a reasonable rate still. It's not like a hard money loan where they're charging you like a big upfront.
Yeah. And if you guys get bored today or throughout the next year or two, go look at your amortization schedule on your current home. And I don't care if it's an investment property or your primary residence, you're going to know for the first 60 months, the first 5 years of that loan is front loaded with interest. And that's how investors make their money. Mind you though, Jim, you can buy out the prepay. If you take a slightly higher rate, you can get a shorter term of a prepay. Now, let's face it, when you buy an investment property, chances you'd be buying it and selling it a year later for profit.
Unlikely. When people do that, it's usually not a good situation.
No one can also predict interest rates either, so we don't know when they're going to come down. So we try to find that happy medium, maybe look at a 1 or 2 year, maybe a 2 year buy down, knowing that if you refinance, you have to pay it back. And what does that look like? It'd be if you pay it off in a year, let's say you have a 3-year prepayment penalty and you to go refinance a year later, you're going to pay 2 years of interest in the form of a prepayment penalty.
That's basically it, right? They were like, well, we need to make at least this much interest. And if you try to pay it off before that point, we're charging you what interest we would have made had you kept it to that point.
Exactly.
That makes a lot of sense.
Or they'll go, okay, well, Mr. Smith, if you want a 1-year prepay, your rate's not going to be X, it's going to be a 0.5 point higher. Because remember, they need to make that interest up somewhere, the investor.
So to kind of illustrate how a DSCR loan actually looks on paper, we have a real life example right now, right? We're in escrow on a property right now. The house in Southern Highlands, it's a 5-bedroom, 2,200 square feet, built in 2014. It was listed at $470K. We got into contract at $450K on it, right? So show us what the payments look like.
Okay, so if we were to do just a regular, here's all my paperwork loan, provide the traditional documentation that we do, the rate is always going to be higher on an investment property loan.
In this example, it is
7.5%.
So in this scenario, we have $450K price, 20% down, which is a balance of $360K. What do those numbers look like in a regular conventional mortgage?
With everything at 7.5 with 20% down, principal and interest only at 7.5% would be $25.17 a month. But remember, we have to take into consideration taxes, insurance, and HOA, which would make that total monthly payment on this particular property at $29.52 a month.
If you just did a regular, traditional, conventional 20% down investment property loan.
Correct. Now, I will tell you,
Providing all documents too.
yes. Now, if you're an investor and you have the means to put more than 20% down, you're going to get a better rate.
Okay.
So anything at 25% down or greater, probably this rate would shrink by about a quarter percentage point, if not a little bit more.
That's why I always say do 25% down.
Now, same client doesn't want to provide the paperwork, has a little bit more upfront costs, might stare in the face of a 3-year prepay. The rate on this property, if we were to do the DSCR mortgage, is going to be 6.5%, so a little lower in rate. But remember that fees are a little higher. Does come with a 3-year prepay, so if rates come down, you're going to pay some prepayment penalty if you decide to refinance. But the total monthly payment would be $22.73 at 6.5%. The total monthly payment with taxes, insurance, everything is $27.08. So it's a little lower.
It's actually lower than
With
doing
less headache. Now, when we're speaking with our families that we help who are buying or investors, we got to talk about our exit strategy, right? Are we going to be in this for 3 years? So we're going to talk about the prepayment penalty and as to whether or not we buy it out.
In this scenario, it looks like, oh, great, DSCR, lower rate, lower payment. What's the catch, right? So what are the costs that are greater by doing the DSCR?
On this particular home, it's going to be about $4,500 more than what it would be if you were to do a conventional loan.
So an extra 1%-ish, $4,500 in closing costs more.
Yes.
And then also prepayment penalty on this scenario was 3 years. And if you wanted to buy it down, it would be an additional cost.
Yes.
But you don't have to.
Either additional cost or you could take a higher rate if you didn't want to pay the cost.
Gotcha.
So you get 2 options on that.
Okay, so in some ways, it's kind of like, well, your payment's about $250 less, right? It cost you an extra $4,500 in closing costs, but you did not have to supply tax returns for yourself, all your businesses, all your rental properties.
And for fun, this particular property, look at it from a short-term rental standpoint. So on the short-term rental, AirDNA had this property revving per month at $3,791. When we pulled the data the other day on just the neighborhood rents would look like, it was right around $2,200 to $2,300.
What if I didn't do short-term rental? What if I was just doing a regular long-term lease and let's say I get $2,300 a month on this? Can I still do a DSCR loan on this?
Yes, and it looks like the math roughly, if we were to take the $2,300 and divide it by the monthly payment, you're above that 75% threshold. That rent factor is where you need to be. So yes, it would qualify. We talked about the advantages previously that you do have that interest only option if you'd like. I will tell you that the rate's going to be slightly higher. Usually you add 1/8 of a point higher to the interest rate to get the interest only feature. And some people like that option because they may want positive cash flow.
Or put in less. There's some negative cash flowing properties right now. That would probably lessen that blow, right?
Yeah, so when we compare the two, if we were to do the first one, remember a DSCR at 6.5%, the total monthly payment $27.08. If you were to opt for the interest only feature, you will take a slightly higher rate, so that goes to 6.625. But the payment goes from $27.08 on a 6.5 rate down to $24.22. So the payment drops significantly. But remember, you're just paying interest only, so that balance is not going to move.
If you're the investor or landlord on this, and we rent it out for $2,300 a month, you're still putting in $122 a month. All right, that's not too bad. If rents increase, it starts bridging that gap some more. How long are these interest only options good for?
They are good for 10 years. So it's a 30-year fixed rate. But for the first 10 years, you have the interest only payment.
Right.
And then after the 10th year, it'll go into a regular 20-year payment. Remember, you've already 10 years into that note.
Right.
You've got 20 years left to pay it off. So that payment's going to go up pretty substantially because it is going to go to a 20-year fixed amortization where you pay it off in the next 20 years.
Okay, so I mean, you enjoy the interest only period just to keep your cash flow in a better situation, but most people would probably figure out a restructure or they might even just sell the property.
They're probably likely to refinance or sell it in that time period anyhow, before the 20-year adjustment.
I have an IO on a house in Idaho, and I'm going to sell that thing as soon as it starts creeping towards that 10 years for sure.
One thing too, there's investors look at home, I think investing in real estate in 2 ways. Do I bank on the hold appreciation or am I positive cash flow sensitive? And so I do believe that interest only option gives you some time to not go negative rent too much and then play the hold proposition of growth.
It's another tool for investors, more or less, right? I think investors are all very unique in many ways. So people ask me, what do people normally do? I'm like, well, depending on what your holdings are, what your portfolio looks like, right? Like if you have a bunch of cash flowing positive homes, you might just lock one up and just say, you know what, my others will offset this and I'm just adding to my portfolio, right?
Exactly.
But if you're just starting out and you're kind of like, well, I don't want to put in an extra $400 or $500 a month just to be a landlord either, right? And then we have options there too.
One other thing why you'd use the interest only maybe is maybe not just payment sensitivity, but let's say that rent factor, if I put an interest only feature on that, let's go back to the initial hypothetical, $1,000 mortgage payment, I need $750 a month more in rents, but let's assume the rents are really $650 on that property, but my payment's $1,000. Well, now if I put an interest only feature on the loan, my payment drops, so now I can still do the DSCR without all the
I
documentation.
mean, this is just a tool for investors. So you just have more options of how to acquire more real estate and structure it in a way that works for them.
Path lease resistance as well.
Key takeaways for DSCR loans, all right? I think the big advantage is no documentation, right? That's really helpful. You may have to pay a slightly higher rate for this, but you have flexibility with using interest-only options with it as well too. This is almost like a stated income loan for a lot of these people. And it's like, if you have a complicated financial picture, being a business owner or multiple businesses, multiple rental properties, you should strongly consider this loan program.
And at the bare minimum, Jim, let's cross compare. Having options when buying a home are crucial, right? I don't want to pigeonhole you into one loan program.
If you're considering buying an investment property and the idea of less documentation and having options like this is interesting to you, please reach out to the number on the screen or schedule a consultation through the link below. You can connect with me and Wes. We could talk about your situation. We can give you all the different scenarios and options you can do to acquire more properties. Don't forget to like and subscribe to the channel. Please share this video with a friend or family member that you know that is thinking about acquiring more rental properties. Thanks for watching. Thank you for joining us and helping us with this.
Thank you, Jim.
And I'll see you on the next one.